Welcome back to Strongman Personal Finance, everybody. We got a sponsored video. That's right. You send me 50 bucks, I make a video on whatever you want me to talk about. And I'll keep you anonymous unless you're a piece of trash. Anyway, let's go ahead and talk about IDEXX Laboratories Incorporated, ticker symbol IDXX. What is this company all about? Have you ever heard of pets before? Do you know what a pet is? It's a greasy, hairy, shedding pain in the butt that costs you a lot of money. Now, we all know the pet industry is pretty massive in the United States, and I would say pretty significant in certain parts of the world, because people love their dogs, they love their cats, they love their pet anacondas, they love everything. And when it comes to spending on pets, people just want to throw money at pets. Don't max your IRA, don't max your 401k, just spend money on doggy woggy. I don't have any pets, by the way. I already have 2 freaking kids. What does this company do? Well, they provide services to veterinarians. That's their primary business. If you're in the vet industry and, some cat lady brings in her cat and it's got like a bulging meniscus or whatever, and, you're not sure what's wrong with your cat, the vet will take samples or whatever, and they'll send it to IDEXX Laboratories, and IDEXX Laboratories will help the veterinarian determine what exactly is wrong with the freaking animal. That's the primary part of their business. They also provide testing for water, like if, a company or a government wants to test for water quality or test for microbes, whatever you call them. That's what this company does. It's basically a scientific-oriented testing center that provides services to veterinarians primarily. So, is this company profitable? Well, yes, it is. It has net income of $790 million on revenue of $3.5 billion. And it's got a $40.84 billion market cap. This is not a penny stock. This is not a clown stock. However, my only concern, and we're going to look at the financials and all that. My only concern is the price you're paying for the future company's earnings. Remember, PE ratio is just a valuation metric where you take the price of the stock and you divide it by the trailing 12 months of earnings per share. Trailing 12 months of earnings per share. So companies that are growing fast and are, doing amazing things and have great growth potential, they're generally going to have higher PE ratios. Now, when it comes to this company, they're growing pretty decently. So let's go ahead and dive into the macro, the big picture of their financial statements. So we can see revenue is growing pretty incredibly. Okay, that's some pretty fantastic revenue growth. Most recently, year over year, they grew revenue at 9.65%. That's pretty impressive. It's more than inflation. We go down to gross margins. Gross margins have been slowly creeping up. So revenue is growing pretty healthily. Gross margin is improving. Operating margin is improving. Profit margin is improving. This is a very profitable company. And free cash flow margin has gone down a little bit. That could be due to capital expenditures. But overall, when it comes to the income statement, very impressive company. They're even buying back shares. Look at that. Wow. What could be wrong with this company? We go look at the balance sheet. We'll actually look at that in more detail on the financial statements. But we compare their total current assets. This is liquid cash, or stuff that can be converted to cash pretty quickly, $1.17 billion, to current liabilities of $883 million. Mostly in receivables and inventory. Now, receivables is just money that you're going to collect pretty soon. You just haven't collected it yet. You provided the service, you just haven't collected the cash yet. The vast majority of their assets, a big part of their assets, are receivables. That will be cash. They sit pretty low on cash, but that seems to be a common trend, as you can see. I'm not worried about this company going bankrupt in the short term. Long-term assets, they got $1.6 billion of long-term assets and $893 million of long-term liabilities. The majority of their assets are in property, plant, and equipment. As a matter of fact, their property, plant, and equipment actually matches their long-term debt. So imagine you have a house, and your house is worth $100,000, and your mortgage is $98,000. That's basically roughly where they're sitting when you compare property, plant, and equipment to long-term debt. Check out the pinned comment below and join our Discord community where you can ask me questions directly via text. And if you sign up for the highest tier, you can actually meet me in person every 2 weeks. So check out the pinned comment, join the Discord community, and let's make some money. And they've actually, it looks like, been paying it down a little bit recently, which is a good thing, you know? Or it could just be a payments that they're doing because you amortize it. But overall, their balance sheet is not the worst thing. So they have negative common stock. What does that mean? Well, I suspect what that means is that they're buying back shares. If you have a negative common stock, theoretically what that means is you're buying shares back for more than you issued them, which makes sense because if your share price goes up and you're buying back shares into the future, you're going to be paying more in cash as a company buying back the shares than you initially issued them for. So we can see common stock is negative. That's share buybacks. We can see retained earnings is just going up in like a nice 45-degree angle like the U.S. stock market. This company's nice. I mean, like I can't fault anything with this company's financial statements. We go ahead and check out cash flow. Operating cash flow is growing. You can see the trend. It's growing pretty significantly over time. Capital expenditures are, pretty decent. They're not spending that much on capital expenditures. Acquisitions, they spent $150 million roughly in 2021. For this company, that's not that much. So they're not very heavy into capital expenditures. This is not a very, long-term asset heavy business. So overall, healthy cash flow that's growing. Shares, that looks like they issued a little bit of shares in the last 2 quarters, but overall, they've been doing some pretty significant buybacks. They're paying off debt. There's nothing to hate, okay? Now we go over to the ratios. Here's my concern with this company. So, the pet industry is growing. We'll go look at some statistics in a second. Everything's great. This company is going to continue to grow. I have no doubt in my mind. The question is, are you paying a decent price for it? Well, we can see the PE ratio is trading within norms. It's pretty high. 52 is pretty high of a price to earnings ratio. Price to sales, 11, trading within the norm. You can see the stock ran up during the pandemic. Price to books, pretty pricey. All these valuation metrics are, it's expensive on the surface, is what I'm saying. But if the company grows or it smashes expectations, you can continue to get a good return. It's really all about the price you pay for the company. Now, the stock price itself, incredible growth. I mean, insane growth. And it looks like this company was a big beneficiary of the pandemic, which kind of makes sense because people are locked down. I need my pets. They're lonely. Cat ladies, they're childless and sad. They need cats to shed and make them happy and do whatever for them. So they had a massive, increase in their stock price during the pandemic. It fell down, but now it's starting to recover. So let's go ahead and look at some research. I did some crazy research into the pet industry. I think we all kind of know the pet industry is going to do well for really one primary reason. Now we can see right here, this is a report from KPMG, one of the big 4 public accounting firms. Veterinary service revenues have increased from $40 billion in 2013 to a projected $62 billion in 2023. That's pretty incredible growth. That's 50% roughly over 10 years. Not insane growth, but pretty healthy. And Credit Suisse, which that's gone, estimates that vet care and related product sales revenue would grow at a 9% compounded annual growth rate through 2025. This company is basically growing at the rate of the whole vet care industry, which makes total sense, okay? So the pet industry is doing well. And then if you really think about, demographic structures of countries, more and more people are, deciding not to have kids. They want to be child-free, and, they want to, live their best life and whatever decisions they want to make. And as our society ages and people are more and more likely to be childless, they're probably going to have a pet, okay? And they're going to have a lot of disposable income. Because if you don't have kids, trust me, I have kids and it costs me a freaking fortune. If you don't have kids, you got a lot of extra money. So we can see some statistics here of a percentage of non-parents ages 18 to 49 saying they are blank to have children someday. And you can see the not too likely and not likely at all is growing massively. Very likely, couples that plan to have kids are very adamant about it, is actually shrinking pretty significantly. This is between 2021 and 2018. So you see over time as demographic structures change, while this may not be good for the economy and blah, 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 it is good for the vet industry. There are some industries that'll do well during the our child-free future where nobody has kids and somehow we survive as a species. But so let's look at the disaggregated revenues of the company. So there's 3 primary business segments. There's CAG. This is their primary business. This is the the medical testing and medical services for veterinarians, water testing, and then livestock, poultry, and I don't know what the D is, ducks, testing for animals. So basically, like I said, if you're a vet and you need services, you have a patient come in, Bingo or whatever his name is, and Bingo is, crapping himself every night, smearing it everywhere. Well, you can get a sample of his, and send it to IDEXX Laboratories, and they can help the vet determine what's going on. But if you look at the growth rate, so their largest segment by far is this, I think it's combined animal group, something like that. What is it actually called? It doesn't matter. But their largest segment, the testing and services for veterinarians, and they have devices too, that's grown by 11% year over year in their most recently quarterly report. Both in the United States, 11.6, and international, 9.7. So their largest segment is growing pretty significantly. Water testing, the second largest, has grown overall 9.2%. And then livestock, poultry, and ducks, or whatever, I don't know what the D is, it grew pretty anemically. So overall, this company has fantastic revenue growth, fantastic profitability. Everything's honky-dory. The question you have to ask yourself is, are you overpaying for the stock price? Me personally, I don't know what to tell you. The risk of this company is that their revenue, maybe decelerates, or their profits start to decelerate, or there's competitors out there that really hurt their business. But overall, there's not much bad to say about the financial statements of this company. I don't think they're going bankrupt anytime soon. It's a very impressive company, but that's the hard part about investing is everything can look good on the financial statements, but that doesn't mean that you're going to have a positive return if you buy the stock right now. The stock has done incredibly, up 552,000 freaking percent since it's, I guess it went IPO'd in 1991, Jesus. But that doesn't mean it's going to continue in the future. So overall, great company. Got nothing against it. They're doing some pretty good things. But me personally, I think I'm just going to stick with VT. Cheers!